Joining us now is 314 co-founder and strategist Warren Pies. He's also the portfolio manager for the FCTE ETF. Warren, great to talk to you. I mean, we got this uptick in new home sales today. And on the same day, of course, we got that dovish message from Powell, huge rally in the Treasury market, mortgage rates coming down, and essentially reinforcing confidence in a soft landing scenario. So how does it all fit together, and what role do you think housing has in whether, in fact, we can still sort of be resilient in this economy?
Yeah, I think housing, thank you for having me. I think housing is everything, honestly. It's there's an old paper, housing is the economy, and it kind of oversimplifies everything, but to a certain extent, there's a lot of truth in that. And at 314, that's how we look at the world. We have a framework for determining whether the economy is heading into a recession, and we focus on residential construction jobs. And so because of that focus, we really model everything out in the housing industry. And, today's data was definitely a good sign. I mean, there's been weakness. It's something we've been concerned about since mid-year. We're still on the soft landing train, I should say, or the bandwagon. But it's nice to see some reactivity to these lower rates. And I think that's what you're going to need to have to keep the housing market moving.
Yeah, I mean, obviously, it's been a little bit slippery in terms of that relationship, right? I mean, you didn't see an immediate burst of demand. You're seeing existing inventories come back online to a fair degree and not immediately being kind of soaked up. So more broadly, how much more confidence did you have after today's message from Powell and the market action, or just were you always in this camp that says, listen, the volatility is noise and we're going to be okay?
Yeah, no, I think that look, to me, there's a lot to get kind of ostensibly worried about in the market. And you'll hear a lot about these things, I think, over the next 3 months. And there's validity to them. So things like seasonality. September is a notoriously weak period for the market. You have NVIDIA earnings next week. Who knows how that's going to break? And obviously the election, which is the huge wild card that nobody knows how to discount. And so in a lot of ways, it can feel kind of scary out there. But the bottom line is, I think since mid-year, this market equation has gotten a lot easier to solve. So the bottom line is inflation is no longer, at least for right now, a concern in the market. And Powell confirmed that today. He talked about inflation in the past tense, which to me, it's a huge change. And it tells me that no matter what, if you're at home thinking about this and you don't think inflation is dead, it doesn't matter. What the Fed, the guy controlling the Fed, thinks inflation is behind us. And that's has huge implications for policy. So with inflation dead, all we have to worry about is growth going forward. So it goes back to your housing question, goes back to, is the consumer responding to lower rates and things like that? But the equation is simplified. So growth is everything at this point in time, has major implications for how you create your portfolio and what we're paying attention to going forward. And ultimately, I think those things that are really headline grabbing risks, distraction, ultimately, if we avoid a recession, the market's going to go higher going into next year.
Yeah, exactly. I mean, all those lines about how, well, it's always been smart to sell the first Fed rate cut. I mean, that really was only because Fed rate cuts often led to recessions, and the couple times it didn't happen, that was a bad play. But I guess within the market, what makes most sense here? I mentioned earlier that, today they sort of just enacted the old playbook, Russell flying, unprofitable tech up 4% or so on the day, banks moving. Does that sort of make sense, or is there another place to do it?
Yeah, for me, our fund and our model, we invest in high quality companies. And I think this is the right part of the cycle for that. I know that if we thread the perfect needle on a soft landing, then yeah, the small caps make some sense, I think. But notoriously, this is a bad time in the cycle to be levered up on small caps. So I've been shying away from that space all year, and that's just where I am philosophically, where we are in the cycle. Mag 7, on the other hand, is a little bit crowded. I think everybody feels that way. And so if you're going to beat the quote unquote benchmark here, I think you're going to need to find high quality stocks that you feel confident holding through some of this volatility that we're talking about. And so that's what we're doing. A lot of that means no small caps, reduced weight in Mag 7, less cyclical exposure. It leads you to the group of stocks that we own.